I acknowledge that I'm hosting this webinar from the lands of the Gadigal people of the Eora Nation. I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. Your webinar is being hosted by partner Restructuring and Risk, Todd Gamble, and your presenters are Peter Benbrick, Tax Consulting Partner, Marcus Polivinio, Tax Consulting Director, and Personal Wealth Management Director, Andrew Yee. Now, without further ado, I'll hand it over to your host, Todd Gamble.
Morning, everyone. There's nothing like a Wednesday morning to talk about tax stuff and get everybody moving through the day. We're going to whiz through a few things today to clarify those normal end of year sort of discussions that we have with each of our clients, some of the things that we're seeing with our client base, some of the emerging issues that are coming through and how it can help manage your clients and give them some potential opportunities over the back end of the year and avoid some of the potholes. So we'll whiz through the certain aspects of it, and private clients and individuals, and then some small business tax planning strategies that we're sort of working through. And then we've got the Superman to talk about superannuation at the back of it, so that we can give you some ideas around some of the things that are there, that some of them are logical and are there annually, but some of them are just idiosyncrasies for this year. So without getting in the way of anybody learning about all these things, I better hand over to Peter Benbrick, one of our doyens of tax, to give us his view of the back end of the year and the things that he'll be thinking through for each of his clients. Peter.
Thanks, Todd. Thank you. Welcome, everyone. See a good few familiar names. I can see we're covering we've got the Shire, we've got a few the city, we've got a few regional accountants. So good to see a bit of a mix there. So welcome, everybody. So as Tanya and Todd said, I'm going to focus more on private sort of individuals and family groups, professionals. So I'll got a reasonable demarcation. So I'll let Marcus talk more about business tax issues. So some of you hopefully might have come across Marcus as well. I know a few of you myself. So the first one, just to highlight, obviously working from home, it's still a thing. See, I think there's I know I'm doing it. A few some people asked to working from home. We had as you would all recall, we had the concessions through the COVID period, which finished last year. So we're back to the 60 cents per hour method, which is a bit different to the special 80 cents, whatever it was in COVID. So these are the sort of things you can cover. And I think my experience, probably most people are using this. It's certainly the easiest one. You keep up work out your hours. That covers up all your home, mobile, internet, data costs, mobile phone, electricity and gas, stationery, that sort of thing. So this is assuming you're not carrying a business from home. If some of you or some of your clients may be running a practice or running a business from home, and which then obviously gives you more opportunities to claim expenses, but then opens you up to losing some of your main residence exemption, as I'm sure a lot of you know. So that's bit of a problematic area, something you have to be careful with. But if you're just working from home, like a lot of people are, then this method is a common one, so it hasn't changed from last year. Or you've also always had the actual method. So if you really could be bothered, or if you think you're going to have that much in terms of claims, then you can work out all the actual costs, but then you've got to substantiate all that as well. So again, I haven't seen too many people use that, but it is there. But fairly simple, 2 methods, and just keep them in mind. So keep moving through. Probably the last couple of slides is where some of the more interesting stuff is. But and obviously, if anyone has any questions, like I said before, happy to take them as we go along. If Todd will probably throw in some curly questions if he feels like it. So but you guys feel free to throw anything in as well. Just stage 3 tax cuts. We all heard lots about that. This is where we are right now. I'm sure you know this is the current rate card, and then this is where we landed on stage 3 tax cuts. So we've still got that 37 cents band that the coalition originally proposed to get rid of. The top band is 190, which is a compromise from 200. But so unless everybody still gets a tax cut. A little bit less than you would have otherwise. Note the 16 cent rate for that second bracket there, as opposed to 19 previously. So again, that just goes into your tax planning for your clients, as to obviously when you're doing your calculations heading into the next financial year, be aware that the rates are down, so that'll inform some of how you do your planning. I'll touch on a few relevant points to that in a minute, but yeah, go on, Todd.
But just back to that residence exemption and all that sort of stuff.
Yeah,
I mean,
sure.
You're not talking sheep station amounts here where you're getting the tax deduction. So
No,
there
that's
is
right.
that balance. There is that balance of the risk that you're destabilising, obviously, the prime asset in a lot of people's sort of.
Absolutely, yes.
Yeah. But is the ATO really going to do it? I mean, is there any cases around it yet, or any determinations, or are they just sort of hanging as usual?
There probably
sort of
isn't.
Damocles is hanging there.
Oh, absolutely. Yeah. There's look, there may be some guidance out there, but it's just really an awareness thing that if you, I mean, firstly, it really is a question of fact. Are you carrying a business from home? And I've got another presentation that I've done where I talk about different aspects of this main residence exemption, and have examples there around like there's particular factors there to look at. Is if you got to say someone, I think the example I had was someone's a physio, they have a room in their house that they use to carry on their practice. It's got signage, it's got separate street access, waiting room, that sort of thing. So there's a lot of factual things. There's one accountant I know who was running his office from his parents' home, not his home, his parents' home, and actually just down the road from me in Mona Vale for about 20 odd years, and he's now rented some office space elsewhere. But so, that's an interesting one because it's not his main residence, so he could probably argue, well, it was still a business, but certainly a lot of people, professionals do, or other business owners do use their home. And so, yeah, as you say, Todd, is it really worth, it's a question of, one, does it stack up? But two, is it actually worth claiming a few deductions if you're going to lose some of your main residence exemption that much? I'd prefer to keep it all, to keep your home tax free in most cases.
But I think there's a level of probability where if you're claiming a couple of grand from working from home, which is still a material amount of hours, to about 67 cents an hour to be able to get up to it.
Correct.
Yeah. I see it as, first of all, politically, and then second of all, it's going to be challenging to be able to enforce that. I mean, who's actually going to see that? It's different, I agree, that if you actually have premises and people come and see you, but if you're like an accountant who is just working from home and doing everything online and whatever else, like a lot of people who have working from home arrangements, I would have thought that eventually that's going to evolve into a consistent regime where you will get a deduction, but it should not, above a certain regime, it's not going to affect your deductibility.
Correct, absolutely. And that comes down to things like, starting to claim some of your rates and taxes, your mortgage interest. Obviously rates are high at the moment, so there's maybe more incentive to claim. Well, electricity, you can claim a portion of electricity that falls within the 67 cents or the actual method. So, because that's usage of the home office. So you actually have a dedicated home office, like a lot of people do. But yeah, start claiming your rates and your 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 mortgage interest. There might be an incentive to do that with rates being high, but yeah, I totally agree. It's probably not worth it if you're going to lose some of your CGT exemption. Is the ATO going to work that out? Who knows? But yeah, you yourself and your clients, you've got to think about the consequences if they do look at it.
Well, it's a little bit similar to the instant asset write-off when you actually then go to sell in a period afterwards where you create a problem, which I'm sure Marcus can throw 10 cents at it.
I'm sure, Marcus will definitely touch on that, I'm sure, but absolutely, yeah. So this is really, I mean, some of this is like year-end tax planning 101, things we talk about every year. It's a little bit more poignant this year because rates are going down. But obviously defer basic stuff, defer income, bring forward deductions. If you're a small business, not a business, maybe if you were a small business, I said I wouldn't talk about business stuff. Sorry, Marcus. Then maybe you can prepay 12 months, have 12 months prepayments. But just the idea of deferring income and bring forward deductions can be useful in any year. But particularly when you're going to pay a little bit less tax next year, and reduce your taxable income this year and push the income or the or claim the deductions this year. So you claim you're getting more value for your deductions. So either way, I'm sure it's what you talk to your clients about all the time, but particularly important this year to do that. Likewise with capital gains and losses, obviously in the last few years we've seen the market do lots of things up and down, and so people have got gains and losses. I know one individual client I'm talking to his broker. It was just realised a couple of big gains and saying, well, what losses have we got to offset? And so we gave him some information on that. I had to also point out that the guy's got like millions in capital losses already from prior years. So realising losses is not really. He doesn't actually need to realise his losses because he's already got plenty. And in fact, probably a point I'd make on that, just while that's thinking about him, because he's actually 90, and we've had this discussion a number of times where with his portfolio, he can't take can't take his capital losses with him. So use them while he can. And he's asked me this question. He's quite, he's thinking ahead to his kids and his wife, who are going to get his portfolio. If you leave some unrealised losses there, they'll inherit his cost bases. So effectively, they'll get the unrealised losses. So he shouldn't realise them. I'll defer to the broker and the client on the investment aspect of it, but or to Andrew's colleagues if they're advising clients on investment. But if it's a good investment decision, maybe make a sale. But from a tax perspective, in a case like his, don't realise the losses if you can't really use them. And but for clients who don't have who have gains and loss positions, then the planning point is consider, if you're realising some gains, perhaps realise some losses as well to offset against it. So again, that's just planning ahead. We've got just a couple of months or a few weeks to plan before year end. So you should be starting to think about that.
And Pete, that's also sort of rationalising and restacking your portfolio to make sure you got balance in it as well, particularly where the future of the market looks like it's going with some uncertainty and things like that.
Absolutely, yep. So I won't comment on the investment and where the market's going, but yes, we should be thinking about that for our clients, obviously, and and absolutely getting them at least considering those sort of decisions. I don't think I'll just mention
getting the financial advisor to map out what a strategy might look like.
That's right. Talk together. I mean, we do a lot of that in-house, so we're talking to our wealth guys, but some of our clients have external advisors. The audience here, you guys, right? If you don't do financial advising yourself, your clients are no doubt liaising with particular financial advisors. So whoever the client has advising them. But yeah, if that's not your area, be talking to the people who is advising them. So get that coordinated advice for the client.
Well,
they should be heading.
It's an opportunity if they have a material upside, downside, whatever else, to get an extra 2 or 3%.
Absolutely, yeah. So it's totally got to consider all that. Yeah, definitely. And this next point is sort of crossing into Andrew's area, but I'll just Andrew might say more about this. But the carry forward super concessions, I know our wealth team have been talking a lot about that. That just note that because those rules started in 2019, that if people have been carrying forward concessional contributions that they weren't able to use, then it's sort of a 5-year sort of timeline. So from that first 2019 year, if they don't use them this year, they won't be able to use them the 2019 ones next year, and then it'll keep rolling, one rolling on every year after that. So just keep that in mind. Look for opportunities to maximise super for clients, and again, get the deductions. Perhaps while the rates are a bit higher as well, possible. Okay, so Todd mentioned before about what paying the right amount of tax. Obviously, don't pay any more tax. The old carry packer thing of it. No, don't pay any more tax than you should be. Within the rules, of course, and managing your risk with the ATO. So income splitting opportunities for different clients, if you're an executive on $500,000 or $1 million, then maybe there's not a lot they can do. But certainly looking at even if there's a big salary and in the family, have investments in another structure, whether it's with the lower tax spouse or investment vehicles, trusts or companies. Obviously, they each have their pros and cons, and I won't get too much into structuring. I'm sure you're all aware of the sort of issues, but people, obviously we look a lot at bucket companies, and you've got all the Division 7A issues to consider there. If it's going through a family trust, you've obviously got to look at Section 100A, but you've all heard plenty about that in the last couple of years. And So all those issues just need to be considered, but these structures definitely have their place. And if it's a business, then maybe the family trust owns the shares in the operating company, or that sort of thing. Just think about all that structuring that gives opportunities. When we talk about Section 100A, obviously what the ATO is targeting is, as you would all know, is they're targeting the university students, the kids that don't have much income. They're not targeting spouse. So, go for your life in terms of splitting the income with your spouse, except for professionals, and I'll get to that. I'll touch on that in a minute. But for most of your business clients, again, why are professionals treated separately? Don't ask me. I think it's pretty. But we'll that's at least whatever structures and situations your client have. Look at how you can spread the income. As I said, obviously with family trusts, bucket companies are still very valid structure, particularly if you're going to put the money into the company. But even if you're not, there's still planning opportunities to do that. So particularly if your income is going up and down in different years, then you can smooth it. Definitely use a corporate beneficiary to smooth things out.
And Peter, the other thing is that the age-old, it's as part of all of those discussions, is looking at the structure to make sure it's set up for succession and or
absolutely.
exit
Totally,
as well.
Totally, yeah. Absolutely, yeah, absolutely. And in fact, and obviously we won't get into too many technical issues, but family trust, when you're talking about family trust elections and interposed entity elections, we're finding that those trust loss rules or obviously family trust elections are relevant for passing through franking credits as well. And those rules are incredibly complex, as I'm sure most people know, and we're finding our firm's picked up quite a large, really wealthy family group with a very large business, and they're finding issues with that structure, with a very complicated structure, and they're finding issues where there's different test individuals on different trusts, and you've got trusts distributing to other trusts, and you just have to be so careful in that area, and it makes, all that ties into
divestment difficult as well, right? The
absolutely,
purchaser comes in and goes, "What am I actually buying here? How do I actually
correct
do this?"
Yeah, because you mentioned succession, Todd. So it's obviously there's different exits, and so whether you're exiting, selling to employees, using family succession, whatever you're doing, you need to be very careful on the structuring. Yeah, absolutely. And if you and planning ahead, if you're thinking about selling, then you obviously at much less risk of ATO activity if you look at your structure of your business now and maybe do a restructure when you're selling in 5 years instead of the year before you sell, and the ATO says, okay, what's this scheme you've got here?
But also on a value point of view, if you're selling to private equity, obviously have a lot of money at the moment. If you have a structure set up and it is planned well and whatever else, it adds credibility to the information you're providing them, which gives them confidence so that it gets across that threshold. It protects value and it makes it easy to do a transaction.
Particularly if you want to sell your company, and because you can, all the due diligence that they'll have to do around buying the shares in a company, which again, with small business CGT concession, those sort of things can be a lot more tax effective if you sell the shares. But yeah, I totally agree, Todd. If you private equity or just a larger corporate player is much more likely to, they're more likely to buy the shares and just fold it into their tax consolidated group or whatever. If it's clean, you limit the risk, limit the DD, you're surely going to be able to get make it much easier to do the deal.
And if you're a development entity which has tax losses sitting in it because it's been funded and wherever else, it makes it a lot easier to be able to get value out of the tax losses then. So you actually can recover them.
Yeah, so, sure. That's right.
So all of those things get layered over the top of all of this structure.
Absolutely, yeah. So there's so many things to think about. I'm sure these are things that most of you are aware of, but again, just a reminder that there's so many things to consider. Yeah. So so again, just touching on a couple of the points we covered there. Obviously, Div 7A. Again, the basics of Div 7A. If you've got loans to shareholders, or there could be UPEs from corporate beneficiaries, you've got to make sure that you get those by the relevant lodgement date. Get the loans repaid in full if possible. There's been a few things said in recent years about if you're going to use dividends to offset the loan balance. I mean, it seems to us pretty logical that you can pay a dividend and clear out a Div 7A loan, but it's got to be carefully documented. The entries have to go through. Sometimes that ATO might be looking for some sort of documentation to prove that there's been cases and ATO activity around, was that actually a valid offset? So it's not as straightforward as you think, but the first thing is making sure you take action, or if you're picking up clients and being aware of those sort of issues they might have, or if you put loan agreements in place, again, get them documented, and then in the subsequent years, make sure that the minimum repayments are all covered. Again, it's all the basics of Div 7A, which I'm sure you're all aware of, but so easy to trip up if you don't do that, manage that properly. And perfectly valid to have Div 7A loan, especially you might even have secured loans, over property, so that to stretch it out a bit. And Division 7A can actually work quite well if the money's been used for income producing purposes. It's where it's funding private lifestyle expenses that obviously there is tax leakage by having Div 7A loan agreements, but you might not have a choice. There might be the only way to deal with it. So either way, just deal with it properly and plan it. Talked about super deductions. Again, just make sure the contributions go into the fund well before 30 June, and documentation. What we see so often is if you're making personal super deductions, get that paperwork, which I'm sure Andrew could probably talk more about, before lodging the individual returns. Or say if you're rolling over from a fund, setting up a self-managed fund, rolling over from an industry or a retail fund, get the paperwork, because it's certainly seen it a few times where you're no longer a member of that fund, and you try and get the documentation out of them and say, well, you're not a member anymore. So bad luck, we're finished with you. So get all that stuff in place before you do anything like that. The profession touched on the professional firms. I'll just mention that quickly. So again, you're probably all aware of these. I think we're acutely aware of it because it's something we have to look at personally. And so most accountants are probably aware of the ATO's new rules, but you'll have other professionals, I'm sure, as clients, and it could be fairly a broad range of. Obviously, medicos have their own rules; they're even stricter. But certainly, a lot of cases. I won't go. There's also, obviously, I will not go into much detail on them. But 1 July 24 is the end of that transitional period that the ATO has allowed. So this becomes a lot more real in the next financial year. So looking at those tests. So Todd, do you had a question? Or?
Yeah. And Pete, we've
or comment.
Yeah, I've seen you guys go through a number of different sort of scenarios with a number of different professional services firms. So you've been across a few of them to be able to look at and sort of apply a practical sort of approach to it, to work within the regime, but to obviously look for opportunities to be able to see how you can structure appropriately so that you can be within, but try and minimising the tax as well at the same time.
Absolutely, yeah. So that's the thing that just make the point there about the tests. We get the old regime was, here's 3 tests. If you can tick one of them, you're okay. Well, they've sort of been more broadly replicated in the new rules with their traffic light risk matrix, but generally all the tests are stricter, and you've effectively got to apply. We don't really focus too much on the one about benchmarking to remuneration. That's an optional test, but employee remuneration. But the share of profits, the 50% share of profits is the ideal. Is you get 50% share of profits to the actual principal or the partner, and get the rest to their spouse or to a corporate beneficiary or whatever through the family. Obviously, if it's going through a family trust, Section 100A makes it a bit more difficult to use other beneficiaries, but use the spouse if they've got tax thresholds to use, and use corporate beneficiaries, and you can sort of smooth that out. So that those strategies still work, but getting 50%, if you get to 50% of the profit to the principal, then you're the main partner there, then you're going to tick that one off, and having an effective tax rate of at least 30% across the group. And then again, as with all these things, the methodology is a bit complex, and I see with some higher earning professionals, it's actually hard to tick those ones, because you really got to balance, meeting the rules with not paying too much tax, to get back to Todd's first point. So I think a lot of higher income earning accountants, lawyers, consultants, other professionals are going to have difficulty getting 50% to themselves, because they're going to pay a lot of tax if they do that. So they might have to settle for that 25 to 50 band, and still probably be prepared to pay at least 30% tax across the group and it's a sort of a top slicing approach. We can have a whole presentation just talking about that, but just bear in mind that the professional income gets stacked on top of the other income. So there's a bit of planning opportunities there, but effectively in terms of that traffic light thing, they want 7 as a green, you're low risk. Probably I find that in a lot of cases the higher earners, you'll have to settle for a score of 8, which means you're moderate risk, which is probably the best you're going to do.
And we might ask at the end whether if parties want us to do a specific prezzo on that, probably in say late July,
right.
August.
Yeah, absolutely. Yeah, I agree. Absolutely.
Let's talk about
We've done it. Yeah, that's right. We've been talking about it. We talked about it when they first came in. We've had a bit of a grace period. That's sort of over now. So yeah, we can definitely revisit that if people are interested. And finally, I better let other people talk. So data matching is continue to expand. We all know the ATO is getting information from all sources. They're only going to get better at it. So they'll find stuff out. So that's probably enough for me. And if we can have any questions as we go on, but I better let Marcus have a go.
All right, we'll hand over to Marcus. He's talking everything business now. As Peter said, he was on the personal and whatever else. This is the business aspect. Marcus, give us some good news, please.
I'll do my best, Todd. Thanks, Peter. Thanks, Todd. Morning, everyone. So I've got a few points that I'll go through this morning, and I've kind of structured it so that we're kind of in the detail to start with, and then we'll zoom out to some bigger picture, tax year-end kind of planning meeting discussion points that we like to work through with clients. So the first few things we've got up there, the first one is just a reminder about the deductibility of superannuation on payments to staff or workers. So in order for the amount paid to be tax deductible, it actually has to be paid and received by the fund before year end. So that's often something we speak to clients about as we're approaching year end. Trying to figure out what makes the most sense, and do they want to make sure that they get that deduction this financial year, and if they do, do they need to make sure they're making payments early so that money hits super funds before 30 June and the business gets that tax deduction. So that's a recurring issue, one that I'm sure we're all familiar with, but it is an important one for clients. The other really topical one, and I might make a few other points about this as well, is in relation to the instant asset write-off. So we've got up there on the slide as a starting point that for the 2024 financial year, theoretically, assets costing less than $20,000 can be written off instantly if the business has turnover of less than $10 million. So is a small business. Now, it's slightly complicated by the fact that was the government announcement. There is a Senate amendment floating around still that actually amends that to increase the threshold to $30,000 and the business availability to medium-sized businesses, so those with turnover of less than $50 million. So potentially that might expand up to 30 June 2024. I think it looks like we won't find out until mid-May. So I guess we have to hold on a little bit. I don't know if anyone's done their morning login to the Accountants Daily, but they've got on the homepage at the moment an article that Peter pointed out to me, kind of making the point that, this is a really kind of stupid situation to be in if we're reverting back to the old way that, every year we revert back to $1,000 and then a specific piece of legislation is passed to increase it up to a different amount. And if you think about the legislative intent of this, partially, surely it's to give a bit of a benefit to small businesses. But what we saw during COVID is it was very much about also incentivizing investment in new assets. And it's hard to see how you're incentivized if you don't find out until 6 weeks before 30 June that you're going to get a tax deduction for an asset. So it's a bit of a complicated one, but either $20,000 or $30,000 assets will be available for full expensing. It's safe to say. I'd make another few points about this, given what we're coming out of. So I'm sure everyone on the call has had a lot of experience dealing with all of the COVID temporary full expensing measures. So, we're coming out of a time where, for a few years, we've basically been able to write assets off entirely. And there are a lot of kind of empty asset registers or pretty neat asset registers out there. We're seeing a few issues emerging out of that. One is, it looks like different accountants and different taxpayers have taken very different approaches to how they recorded their kind of write-off of the assets. So, we've seen somewhere, their accounting equals tax asset registers maintained, which, has some funny impacts on your accounts. So, we've seen some really asset intensive businesses writing everything off for tax and reflecting that in their accounts, which kind of makes your asset position not look very good and makes your profit not look very good. And, if you're just a family held company, maybe that's fine. But we've seen it come to a head when businesses have gone to sell and someone doing DDs looked at it and gone, what's going on? Where's the profit?
Or get finance. How do you get finance
Yeah.
if you can't show your assets?
And that's where I've seen a really bad outcome, is where a very asset intensive business was just reflecting everything is written off in the accounts, but was also financing all of the assets. So there were these huge liabilities and no assets to back them, which doesn't make a lot of sense. In the alternative, we've seen it done where, the accounting depreciation is separate to tax, but a kind of proper tax asset register hasn't been maintained. So there's increasingly complicated spreadsheets floating around with, an increasing number of years of adjustments, and that works. But I think the point we'd make is that, this issue isn't going to go away. I think Todd or Peter made the point earlier that it comes back when you go to sell the asset. You need to be able to track what you'd written off. Does it have a zero cost base? What is it? So we're kind of using year-end planning as an opportunity to make sure clients' asset registers are tidy and will actually, are fit for purpose going forward. And most software has the capability to run a separate accounting and tax asset register, and it doesn't take a lot of extra time to put the two rates in when you set up the asset. So we're really encouraging.
Yeah, sorry, Marcus, go.
I was just going to say, we're really encouraging our clients to do it properly and maintain separate asset registers if there is an accounting and tax difference.
Because I assume
Go, Pete. I was just going to say we might be making similar points, but just as as you say, Marcus, when you're selling, you got to if there's really, really valuable assets in there and they're not recorded properly, then again, like Todd alluded before, to if it's PE or someone else buying, and I mentioned that they might be putting it into a consolidated group example, so they ideally want to be able to say, we bought these assets for this amount at this value. So when they do their consolidation entry calculations, they can get a whole lot of depreciation. And if you haven't got recorded it, you're going to make that a lot harder for them. So if you want someone to buy you, make their job as easy as possible.
And ideally, try and set yourself up if you're eligible for CGT concessions as well, I would have thought, because otherwise you are going to get hit by a tax bill on the way back out.
Yeah. And we have seen some funny outcomes, or the temporary full expensing kind of flow into discussions around sale of businesses as well. I think there were some amendments made, or it was clarified that, for example, if you buy a business that's written off all of its assets, you're kind of precluded from getting the uplift on those when they join a consolidated group. But you kind of also lose a bit of your allocable cost. So that has also, in some instances, swayed buyers to maybe more towards buying the assets rather than the shares because of the depreciation issue, which often isn't the best outcome from the seller. So there's a bit of complexity in there. And in terms of maintaining the separate asset registers, I think we'd say, so far as tax risk goes, depreciation is traditionally a fairly low risk. If you get your rate wrong, that's probably a timing issue. If the ATO pick it up in a review, they might make you fix it. But, if it's not a huge difference, it's not something they're likely to consider a huge risk. But if you get your asset register wrong and you've written something off and then not picked up the gain when you've disposed of it, that is a permanent difference and something that you are likely to get have more of a problem with. So that's the points I'd make on those two. So then next slide. So yeah, there's a few things that we've kind of alluded to here and kind of overlap with some comments we've made a little bit already. One is around the small business CGT concessions. So, what does that have to do with year-end planning? A few things. One is, I guess as an overview, those CGT concessions are some of the most generous concessions out there. And, as advisors, a super powerful tool to making sure that our clients can get the best outcome where they're going to make an exit from their business. Importantly, the rules are quite complicated. There's a whole heap of thresholds and things that need to be considered. So making sure your client structure is correct and they're set up the right way is really critical. So from a year-end planning perspective, it's a really good conversation starter to lead our clients into, talking to us about their broader plans, not just the, nitty-gritty of tax, but, what do you want to do over the next 5 years? Do you see yourself exiting? And if there is a discussion around a potential exit, being able to talk to them about, well, do we need to look at your structure? Do we need to look at your arrangements and see what we can do to put you in the best position when the time comes to be able to access these concessions, because they will make a really big difference. And when you can demonstrate that difference, that's advice that clients are generally pretty interested to hear. So
and even for sell downs, Marcus,
Yeah.
so that you get a little, so you've got a structure where a sell down is easier, so that you can get an investor in to gradually take over. With a lot of these personal service businesses that have been around for a long time, you need to have that structure so somebody can actually come in. It can't be sitting in your family trust necessarily, because it needs to, and we've got one at the moment where we're having to extract it out of the family trust to be able to make it saleable, right? It's complex.
Yeah, and I think you made the point earlier, Todd, that having something neat, clean, increases the chances of a buyer being willing to buy shares, which will often produce a better outcome. So we've seen that a lot. I worked on quite a big transaction recently where the client, it was essentially a private business, but it was quite large, and the structure was a bit odd, but it was for a specific purpose, and that's how the taxpayer liked it. But when they went to sell, the buyer did due diligence and said, well, we don't want that. So it created a huge amount of work to kind of move things around and restructure things, which obviously adds risk to a transaction as well, immediately before. So yeah, being structured and ready for those types of scenarios is quite important.
Yeah, and that example you mentioned, Marcus, is you've probably got a lot of commercial reasons that you can give as to why you're doing it. But actually, if you restructured, as I alluded to before, if you restructured not long before a sale, the ATO is going to look at tax reasons for the restructure as well. So, and also worth pointing, you've highlighted on your slide the thresholds, especially the $6 million net asset threshold. Like it's quite hard now, or probably almost impossible in a way, to use the turnover threshold for selling shares. It's more, I'd say, more in like selling in, like if individuals own farms and those sort of things, and that's where it works, the turnover test. But yeah, $6 million is net assets is what we're looking at mostly, and obviously if they can restructure before they exceed the 6 million, that's a good planning thing, and it gets them into that cleaner structure that you were talking about. So again, that's all planning, thinking ahead.
Yeah, 100%. We've then got kind of an ongoing point there about the timing or recognition of income. So, as it approaches 30 June, we like to talk to our clients about, looking through what invoices, they still need to raise, and considering the timing of raising them. So, is it income that should be recognized before 30 June? How does the year look? How does that compare to next year? Is there a benefit in ensuring that the invoicing, is optimal? So, it might be that they want to bring invoicing forward. It might be that they want to, not bring the invoicing forward and they're happy for it to fall into next financial year. But that's kind of an ongoing important conversation to be having with clients. So then on the next slide, I've got a few bigger picture things that I'd like to talk about. So the first one there is tax governance. Now, this is something that's really relevant to really large taxpayers, but we're seeing it trickle down. So if anyone on the call has been through a recent kind of ATO review, particularly like a Next 5000 type review, Todd, your hands up, you've done it. Yeah, we've been through quite a few. And one of the big things the ATO are looking at is tax governance. And so that is, what processes, procedures, documentation does the taxpayer have in place to deal with tax risk? And, historically, the answer is not a lot, but, the expectation is much higher now.
And that also reflects that they ask the tax agent and say, well, what do you have to be able to make sure that everything is tickety-boo effectively, and what structure and information do you have?
Exactly. And so, at the large end of town, a lot of those responses include, the tax agent sharing their processes. So we've, in those reviews, shared our checklist and procedures of support. But there's also an expectation that the client has their own internal procedures.
Part of that, Marcus, sorry to cut in, just because I know, like, as you say, we've all seen a few of those reviews, and part of that seemed to revolve around, like, when does the taxpayer, like, how do they assess the risk? Like, as you're just about to say, you're just saying yourself, how do they assess risk themselves? When do they let us know there's a transaction they're looking at, or there's something they're doing that might need a bit of advice? So when do they seek advice? I guess is sort of partly what it comes down to, and showing, their process and then our process and how they interact.
I think the when do you seek advice is probably the most relevant bit for SMEs. So I think, for a large kind of next 5,000 type taxpayer, they've got a big internal sophisticated finance team. There's an expectation that they probably have tax governance framework in place. For an SME, I don't think that expectation is there yet necessarily, but there certainly would be an expectation that they have something in place that deals with tax risk. And for a small business, a lot more of that will fall on the tax agent. So I think it's for us, reminding our clients that is the kind of direction that the ATO is heading in, but in particular that they should be reaching out to us if they're out of the ordinary transactions, anything new or anything high risk, and that they are kind of documenting either internally or by getting external advice, how they're treating it and why it's right, essentially.
And having dealt with Revenue New South Wales on a major matter recently on payroll tax, I suspect that they will be doing a similar approach now with payroll tax, particularly now they've got expanded sort of approaches across subcontractors, even into looking into larger groups. Like the mortgage brokers are obviously up in arms at the moment about being grouped together. So these are the types of issues that I think everybody will start to have to focus on again.
Yeah, absolutely, because as you say, Todd, we think the ATO is difficult until we start dealing with the state revenue authorities. It's like
Peter, don't say that, Peter.
They can be pretty. But there's a lot of risk there as well. It's not something people focus on as much.
I think all of these parties are under-resourced. So the problem is that then they push the requirements out onto the providers and the whatever else. So again, it's another reason to have things like audit insurance and all of those sort of protection mechanisms in place to give yourself some sort of structure.
Yeah, and I think the payroll tax point is a really good broader point as well, because I think often when we look at kind of tax risk for clients, we're really across the income tax risk. But the review and the focus is coming from a lot of other areas. So payroll tax is one of them. But from the tax officer's perspective, we're seeing a lot more GST reviews as well. And where we've seen a lot of risk there or a lot of problems is where clients have moved things around internally, like, they've done an internal restructure and they've considered the income tax, and, the GST transactions might be a wash, but from the ATO's perspective, you should still be, issuing invoices, charging, remitting, and, there's a potential risk there if you're reviewed. So we've seen that come out of some next 5,000 reviews. So yeah, don't forget about everything other than income tax as well, is a really important point. A few basic things now. So payment of dividends, often, part of the year-end planning meeting is what dividends are we declaring this year and can we help you with a dividend resolution? So I'd make a few points there. One is, obviously the importance of having contemporaneous documentation and, dotting I's and crossing T's when it comes to minutes and resolutions and statements. But also not forgetting the bigger picture requirements. So, if you're going to frank a dividend, making sure that the franking account is properly maintained and there are franking credits there to support it. Making sure that you are actually satisfying both the Corps Act and tax rules about paying dividends out of profits and recording them properly. And the other point I'd make is, that can be more complex than it seems when we've worked through it. But one opportunity is the ATO has a kind of old ruling, I think, around the use of reserves. So, for example, if you've got retained losses or you've got historical losses and you have some good years, you can actually put your profit in a profit reserve for good years and pay dividends out of those profits. Which can just be something that helps you get franking credits out when otherwise you might not be able to be, and adds where we can add big value as good accountants.
And also probably franking at the right rate too, Marcus. I mean, obviously, we've seen when I was talking about professionals, like say firm structures, you can have stuff going through family trusts, or depending on how that all unfolds, it's quite easy to have potentially 25 businesses paying tax at 25%, but you wash it through a family trust through a dividend, and it ends up at say in the corporate beneficiary at 30%, and which I think is not actually a bad thing, because if you pay a bit of top up to 30%, then you can frank it 30% to the individual. So, but just getting all that right can be a bit complex.
Yeah, it's not straightforward. So really,
and not making sure you're not either having excess credits or that are trapped in the company, or having deficiency, which you can kick the can down the road if you haven't got enough franking credits, like you're saying. But it'll come home eventually if you so trying to manage all that can be interesting too.
All right, we
Hmm.
need to keep moving. I know you guys love your franking credits and your tax discussions, but we need to keep moving on, right? So let's just.
All right, a quick big picture point. Year end is a good opportunity to check in with clients, just generally that their structure is right and still fit for purpose. So, we've made the point earlier around, how that can impact stale, but also we just see clients have old structures that, they don't need anymore and you can tidy them up. The other thing is what other documentation is there, particularly for clients that have, that aren't owned by one family or one person that have, multiple different interests, pushing them on shareholders agreements. I find when you bring it up, you don't get a lot of love, but when you actually make the point, well, what if something happened to your business partner? Do you want, and their kid, do you want their kids on the board? Do you want to be working with their children? Do you want to be working with their spouse? You get a bit more interest and, people start to realize that that's actually really important. So, we saw an example where, a very large business, one of the shareholders passed away and shareholders agreements hadn't been looked at in, I'm pretty sure a typewriter wrote them. And it made a huge mess and it really distracted everyone in the business from running the business. So, again, like even if our clients don't want to take it up, reminding them and pushing them is really important part of our job.
And the other thing I'd layer over the top is security structure here. From
Yeah.
my point of view, is making sure and understanding how the security structure works. And if there's money coming in from the shareholders or another related party, that should be secured and fit in the security structure on a reasonable basis. There's no reason why a bank would say no if you've got layers of security and it sits at the bottom. They actually would appreciate it because they can see it and it's transparent that the money is coming in and where it sits. So
Yeah.
they're always things to get in there because that makes sure that you're getting the value and you're protected and it's clear with everybody. So you have those disputes, potential issues, Marcus, everybody's signed off on them and the security structure is transparent as well, rather than we end up with all of these discussions is that's not a loan, that's equity,
Yeah.
and that just spirals into a dispute.
Yeah. No, that's such a good point.
All right. I appreciate, mate. That was all really good. We'll get into the Superman now for his super update. Andrew.
Hello, everyone. Nice to see everyone here today. Yeah, I'll be talking about superannuation, and as you all realise, that superannuation is a very key component of year-end tax planning, whether you're a professional or business owner clients. Superannuation is always going to be at the top of the line in terms of year-end tax planning discussion. So I'll just run through what the main topics that we normally discuss in terms of maximizing super. Just to reiterate that we're not providing financial advice to our clients unless we're financial planners or advisors, and we're just providing factual information, or we're providing that information on a general purpose or tax planning purpose. In terms of contributions and pensions, just a reminder to your clients that you're just providing it on a general basis, on a factual basis, and not as an advisor and on an investment or financial advisory basis. So just to run through maximizing super contributions, in terms of concessional contributions this year, the limit is 27,500, and that's for all individuals, generally all individuals under age 75, and this cap is inclusive of the super guarantee contributions. So you need to factor that into the 11% that employees get in terms of the cap. So bear in mind the super guarantee. And as an aside, be aware that the super guarantee rate's going up from 11% to 11.5% from 1 July 2024. And also, just bear in mind when you providing these contributions planning advice that you have to be mindful of the Division 293 tax. So where clients are earning 250,000 or more, that they'll be paying an extra 15% contributions tax on the concessional contributions. Also be mindful that if your clients are age 67 and above, that they also need to meet the gainful paid employment test. So they need to be working at least 40 hours in a consecutive 30-day period. So I know that's changed from a couple of years. So it used to be age 65. So that's gone up to age 67. So just a reminder. If the clients are over age 75, then only the mandated or the compulsory super contributions are permitted. So there's no opportunities for sacrifice or getting up to the contributions cap. And also just like to reiterate what Marcus and Peter covered. Make sure these contributions are made early or mid-June rather than late June, because we know with electronic banking, quite often it'll take a few days to hit the bank account of the super fund. So you might end up losing that contribution, and that contribution not falling into the current year and falling into the next year. So just be mindful with clients to get those contributions in earlier. If you find that you may have calls from clients on the 30th of June, what do I do? Can I make a contribution now? But usually that time's too late, but you may be an opportunity, if they have a self-managed super fund, to say, which wouldn't happen with a public offer fund, to write a check for, say, that's dated pre-30th of June, and then as long as you bank that check pre-30th of June or shortly afterwards, that should also count, because it's under the rules, it's when the contribution is made. So if the individual's written a check before 30th of June and they banked it, regardless it hasn't been accepted by the bank or cleared until after the end of the year, then that should still count, because it's under the legislation, it's when the contribution is made. So that's only when, you've got those conversations at year end, but, stress to the clients, try to make those contributions earlier on. And in terms of next financial year, with a WOTI and the inflation rate, so that cap is now will be increased to 30,000. So that's something you need to make your clients aware about. All right, so I think Peter's also covered this early on. Extra contributions, so carry forward contributions, that's a very handy tool now. Not many clients are aware of this or applying it, so it's up to us to remind them that they've got this ability to use unused carry forward contributions where they haven't utilised the cap in previous years, to utilise any unused carry forward contribution caps in the current year. Now that concession allows you to carry forward any unused contribution caps for the next 5 years. So it commenced on 1 July 2018. So technically 2024 is the last year you can claim any unused cap from 2019 year. So if we look at the table here, if a client hasn't claimed anything over the last 5 years, that potentially they can claim 157,500 as a contribution and claim a tax deduction for that whole amount. So that'd be pretty helpful. Yeah.
Andrew, so the balance is under 500. So if you've got a self-managed super fund with, how is that split up between the individuals in the super fund, or is it just for the super fund for the 500?
So that's for the individual, and that's for the individual balance. So if the individual balance is under 500,000, that's a good point. Then they're able to utilize this concession. So
if they've got a self-managed super fund, you can split the balance between the parties, or does it need to be proportional?
You can't split the balance, so it depends on your own balance.
Okay.
Splitting balances is more pertaining to, so you can split contributions, but you can't split your balance.
Okay.
So And it can be a self-managed super fund or can be a normal public offer fund. So it's
Yep.
not confined to any particular super funds.
Yeah.
So
It's just that
yeah.
self-managed super funds generally have probably got balances above $500,000. So that's sort of hence why they're a self-managed super fund.
Yeah, I think you're generalizing a little bit.
Yeah.
But you're probably true as well. So it can be a powerful tax planning tool and claim quite a large deduction for your clients. But again, be aware of the Division 293 tax when you're giving advice on this area that you might have forgotten. Well, there could be an extra 15% tax that you haven't advised about, and then client will see that in a tax assessment, and they'll come asking for you about your advice. Next slide, please. Further on about not contributions, I'll discuss about the non-concessional contributions. That's the contributions that you're unable to get a tax deduction. So be aware if your client's got monies that are able to put into superannuation, that they can put in similar to the concessional contributions, as long as they're eligible to make contributions, they can contribute 110,000 per year or bring forward 330,000 brought forward over 3 years. So that's the current contributions caps for non-concessional contributions. And that will also be increased after 1 July 2024. So that'll increase to 120,000 or 360,000 brought forward for over 3 years. So once you've triggered the annual cap, the 110,000, so even if you go over that cap, over say $1 over that cap, then you are effectively triggering the bring forward cap, and so that'll limit you to 330,000 over 3 years. So you have to be careful if you're going over that cap that you're not you're triggering that bring forward rule. So similarly, with concessional contributions, it's limited to those over under age 75. There's a little bit of a window if you're age 75 and 28 days. So technically age 75 plus 28 days that you can make your contributions in. It's similar to the concessional contributions. But with non-concessional contributions, be aware that if the person has $1.9 million more in superannuation benefits, what they call this total super balance cap, on 1 July, in this instance, 1 July 2023 for a $1.9 million total super balance cap, that they can't put any more non-concessional contributions into super. So they're just limited to the concessional contributions cap. And for individuals with age 67 to 74, and if their total super balances are below 300,000, they can make the voluntary contributions to the superannuation fund for 12 months from the end of the financial year in which they last met the work test. So for non-concessional contributions, they up to age 75, you don't need to meet a work test in the same way as you do for concessional contributions. So that was a change in the rule that came into play a few years ago. So that's a little bit of the difference. So don't get confused that just because you can make contributions up to age 75, that you don't need to work the work test. You still need to work the work test if you're claiming a tax deduction for that contribution. Just be mindful of clients that have pensions or commenced pensions in their fund, to remind them to make the minimum pensions, take out the minimum pensions before 30th of June. So we've got that table there. If you're aged 55 to 64, you got a minimum pension rate of 4% based on your member balance. Now, just be aware that in the last few years, because of COVID, the government reduced that minimum pension percentage by 50%. So instead of 4%, you will have 2%. So just be aware it has gone back to up to 100%. And if your clients have regular payment arrangements made with their bank to make that adjustment, otherwise they'll have that shortfall and not meet their minimum pension requirements, and that will have other implications in terms of the taxation of the fund income. So if they're in pension phase, normally it's tax-free, but if they haven't met their pension during the year, technically their pension's commuted from the start of the year, and they'll pay tax at 15% in the fund. So just be aware that those COVID arrangements are now finished, and it's back to the normal percentage rate going forward. And if you're considering, if clients are considering commencing a pension, just be aware the transfer balance pension cap is now 1.9 million. So they can commence a pension, retirement phase pension up to 1.9 million. Anything above that will be just considered excess benefits in terms of pension transfer balance cap. We'll cover a few tips for those clients that have self-managed super funds. Just remember to obtain updated and independent valuations for all assets, including unlisted assets and real property. So that's the real focus now for the ATO. They're really targeting self-managed super funds that have assets, especially property, and they're looking at the valuations. So if they say that they've seen no movements in the tax return over the last couple of years or 3 years, then it could be an issue for them, and there may be a risk that your client and the auditor will be targeted for audit. So I think the ATO's put that out there, that they've seen tax returns showing no movement in asset values over the last 3 years. So that they think that's a real concern, that trustees are not doing the right thing. They're not getting the valuations, and auditors are overlooking that. Now, you probably think, well, does it really matter? Well, I guess it matters in terms of now that you've got these transfer balance caps and what you can put in, and that's all being tested, and in terms of what your pensions commenced on, it's all dependent on valuations of the fund.
Andrew,
So
it
that's
depends. It depends on the data they want to have to see where people's balances are at and what the tax concessions are on the property that's in those super funds, right? That's where they're trying to gather data.
That's right. That's right. And that's that, and we can see that being much more important with this what the 3 million tax on member benefits coming in. So the importance of valuation can't be underestimated. So we just have to get into the habit. If you have these assets in the fund, get them valued, because that's a real focus for the ATO, and you have to make it easier for the auditor as well, because they'll be asking you as well. Other tips, make sure you review that if you have related party transactions. So if their members are carrying out transactions between the fund, make sure they're all at arm's length. As we know, we've got the new non-arm's length expenses rule coming in or already in, and that'll also be a real focus for compliance for the ATO. Review the investment strategy of the fund, or encourage the trustees to review the investment strategy. Make sure they're up to date and they're relevant to what the trustees are investing in, because that's something the auditors are going to have a look at strongly as well, and pull you up if there's any differences in investment. And then they can also report that if your investment strategy doesn't align to what the investments in the fund are, that they can actually report that to the ATO as well. make sure that you've already, that your self-managed super fund clients or have already appointed an auditor, technically no later than 45 days before the lodgement of the annual return. So if you've got a new self-managed super funds have commenced in the 2023 year, of course they've always should have had their auditor appointed, but they should have also had their return lodged by 28th of February 24. And if they haven't, I mean, that again, that's going to raise a flag to the HO, because that's another area which the HO are targeting self-managed super funds that are not lodging returns, and quite often there'll be multiple years, and they'll take them off their super fund lookup register. So just make sure, for your client's sake, and you select that all those self-managed super fund returns are lodged on time. The other issue that you need to be aware of, that transfer accounts caps, transfer balance account reports, they need to be reported now every quarter. So 28 days after the end of the quarter, if your client in the self-managed super fund or has commenced the pension, or they stopped the pension, or they altered their pension, then they need to lodge a report with the HO on a quarterly basis now. Previously it was an annual basis, but now it's on a quarterly basis. Now, it's not the end of the world if it hasn't been lodged, but you should still get it lodged. I haven't seen a penalty for non-lodgement or late lodgement of a T-bar, but that doesn't mean that they won't be penalised, because there is a facility for them to be penalised. So make sure that they just get lodged, okay? I think that was it in terms of topics for self-managed super funds.
Thanks, Andrew. That was interesting, and obviously still a lot of complexity in that area. So we have a question from Liam that I think, Marcus, you're probably the best to deal with. Is a holiday home which has never been rented a personal use asset for the purposes of the $6 million asset test for the CGT small business tax concessions? Marcus, your thoughts?
Yeah, sure. I think the answer is yes. It is excluded, so it is considered a personal use asset. And I think there's a case from a number of years ago where actually, a property had been rented out, and shortly before the CGT event ceased being rented out. And the taxpayer argued that it was a personal use asset, and I think they lost, but purely on the basis that they hadn't actually started using it as a holiday house for themselves yet, which would even suggest that there is a line in the sand somewhere where if you have rented it and you've stopped renting it and you are using it as a holiday house, you can potentially get it in. It's a good example of how a little bit of good advice in advance can make a difference. If you tell your client, hey, kick the people out before you sell, that's win-win, and that might save you 7 figures of tax, then that's pretty win-win advice. And a reminder there's
dump money into super with Andrew's thresholds and all of those sort of things to bring cash out of businesses and things like that.
Yeah, exactly. There's some really important big ticket items that are excluded. So like super is a big one, and the other one is cars, boats. So if a client's going to retire and buy a boat, they might want to bring that forward to just before. So yeah, there's some really useful tools there.
And you get into things like, I know we're going to wrap up shortly, Todd and Tanya, but just you get into things like where they're on the line with a $6 million test, giving money to their kids, as long as the kids aren't included in the group. I've had that situation where they said, I'll give some money to the son, so for a deposit on a house or something, and they said, oh, no, but he got trust distribution, so his assets are grouped anyway. But again, look, all those sort of things, strategies you can look at when you're doing that planning.
Okay. Well, I think I learnt again today that you can't take your tax losses with you, so make the most of them. And a few other different things about planning. And as I said earlier, if everybody would like us to do an update on the changes in the trust sort of structures for professionals, I'm happy to do that in sort of July, August, so that everybody can get their planning done for next year and think about it. There's also the other contacts that Tanya's put up there. Let us know if you'd like to have a chat, even if you just want to talk about some of these things. It's sometimes better to go through that action with these guys who deal with it on a daily basis, as you can tell, and live and breathe these things. So it's just a good way to have a discussion. I do it a lot when I hit it with all of the matters that I hit. and particularly at the moment with the ATO being so active, and you ask about certain issues and you need to talk to somebody who actually does that, and that's what they do. So appreciate everybody's time. I know we've run a little bit over, but it was fairly interesting and there was a lot of things to discuss. I hope you have a good day.